Imagine a single investment option that offers the benefits of mutual funds, the simplicity of stock trading, and the potential to build wealth efficiently. Sounds perfect, right? Meet ETF, Exchange Traded Fund, a modern day investment vehicle designed for everyone, whether you are new to the stock market or a seasoned investor. But what makes ETFs so special? Why do financial experts often recommend them as part of a smart investment strategy? Let's dive in and find out. So let's get the basics right. What exactly is an ETF? An ETF or an exchange traded fund is like a basket of investments. Imagine you want to invest in India's top 50 companies. Instead of buying shares in each company individually, you buy one ETF that holds all these companies for you. When you invest in an ETF, you are essentially buying a small piece of a larger portfolio that tracks a specific index, sector, or a commodity. Whether it's the Nifty 50 index, gold, or even silver, ETFs give you exposure to multiple assets with a single investment. ETFs are regulated by SEBI in India, which means your investments are safe and transparent. But here's the important part. When you buy an ETF, you don't own the stock directly. Instead, you own a share of the fund that holds those stock. Now, here's the cool part. ETFs are open-ended, meaning there's no limit to how many people can invest. And unlike mutual funds, which updates their prices only after the market closes, ETFs trade on exchanges throughout the day. This means you can buy and sell them anytime the market is open, just like any other stock. Flexibility and simplicity rolled into one. There are various types of ETFs available in the market. Passively managed ETFs. These are designed to mirror the performance of a specific index like the Nifty 50, Sensex, or even international indices like the Nasdaq 100. If the Nifty 50 index includes 50 stocks in certain proportions, the ETF will hold the same stock in the same proportion. So, what's the goal of a passively managed ETF? To match the index, not beat it, lower cost for you since there's minimal management efforts involved. Examples: SBI Nifty 50 ETF, HDFC Sensex ETF, so on and so forth. Actively managed ETFs. Unlike passive ETFs, these don't target index. Here, professional fund managers make decisions to buy, sell, or hold assets. The goal? Higher returns. Commodity ETFs. Want to invest in gold, silver, or even crude oil without the hassle of physical ownership? Commodity ETFs makes it easy. They diversify your portfolio and are cheaper than actually buying and storing these commodities. Industry and currency ETFs. Industry ETFs focus on specific sectors like banking or technology. For example, Nifty Bank Bs track the Nifty Bank Index, focusing on banking stocks like HDFC, ICICI, SBI and the likes, while the Nifty IT ETF tracks tech firms in India. Currency ETFs track the performance of a currency relative to another. They help in hedging against currency fluctuations. For example, Nippon India ETF Hang Seng Bs provides exposure to the Hong Kong dollar. While India doesn't have many currency ETFs listed locally, global currency ETFs like the Invesco currency shares, Euro ETF or US dollar ETFs can be accessed through international investment platforms. Before I tell you why you should invest in ETFs, let's discuss their pros and cons. Let's start with the good stuff. Diversification. Instead of putting all your money in one stock, ETFs give you exposure to multiple assets, spreading out your risk. Cost effectiveness. ETFs have some of the lowest fees, often as low as 0 to 0.5% compared to mutual funds which charge 1 to 2% annually. Tax efficient. Less tax on your profits compared to mutual funds. Transparency. Daily disclosure of holdings, so you always know where your money is invested. But here are some things to consider. Brokerage fees. You will have to pay brokerage fees when buying or selling. Market volatility. Since ETFs trade like stocks, their price fluctuates throughout the day. This can be unsettling for some investors. So, why should you invest in ETFs? ETFs are a solid choice for anyone looking to invest smarter, especially if you are new to the investing world. Low risk investment. Thanks to diversification, if one company in the ETF does not perform well, others might balance it out for you. High diversification. Investing in a Nifty 50 ETF, you're getting exposure to the top 50 companies in India. Tax efficient. ETF minimizes capital gains taxes. Low fees. Many index ETFs have an expense ratio close to zero, 0.05% to 0.1%, while mutual fund charges 1% or more per year. Now let's talk about why these small fee differences matter so much. Let's say you invest 10,000 every month in both an ETF and a mutual fund. The mutual fund charges 1% annual fee, the ETF charges only 0.1%. At first, you may think the fee difference is very small, right? But due to the power of compounding, that small difference grows into huge amounts over the years. Here's what happens over 30 years. Assuming a 10% return year on both the investments with a 1% fee in mutual funds, your 10,000 monthly SIP would grow to approximately 1.8 crores after 30 years. With a 0.1% fee on ETF, the same 10,000 SIP would grow to approximately 2.25 crores over the same period. So, the difference in the final value is about 40 lakhs over the 30-year period due to the smaller fee. This demonstrates how even small fee differences can lead to significant differences in the return over the long term. And that's why index ETFs are a no-brainer. Most actively managed mutual funds struggle to beat market. So why pay higher fees? Now, a quick message to my friends who love to invest in gold and silver. Want to invest in gold but don't want to have the hassle of storing it? So go for gold ETF. One unit represents 1 gram of 24 karat gold. They are highly liquid, they're easy to buy and sell. They are much safer than physical storage and no lock-in period unlike sovereign gold bonds. The only drawbacks are gold ETFs don't offer dividends or regular interest which is offered in SGBs, which is about 2.5% per annum. And gold ETFs are subject to capital gains tax. Same goes for silver ETFs. Invest in silver ETF without hassle of storing it. Silver has industrial uses, making it price responsive to economic demands. It's more affordable than gold, allowing more people to invest. Like gold, silver is also low correlated asset, making it a choice for diversification. Plus, higher volatility in silver can lead to potentially higher returns during economic upturns. Increasing EV use in India adds more to its value. However, silver's price volatility can be a disadvantage during tough market conditions. Additionally, silver ETF tends to have lower liquidity than other assets, making it harder to buy and sell quickly. So, if you really want to invest in these commodities, an ETF is a good option to diversify your portfolio. To sum it up, ETFs are game changers for modern investors, offering diversification, cost efficiency, and ease of access. Whether you're looking to invest in indices, commodities like gold and silver, or specific sectors, ETFs can help you build a well-rounded, diversified portfolio. So, take charge of your financial future. Understand your options, choose wisely, and let ETFs be a part of your investment portfolio. That's it from me. I'm Nikhil Varghese. Share this video and subscribe below to make your finances less tricky with FinNiki.